People keep asking me what to buy in April 2026, as if the answer is supposed to come from a crystal ball. It does not. It never did. The problem is that most investors still think the market owes them clarity before it owes them opportunity. They want every headline lined up, every war cooled down, every tariff argument settled, every politician quiet, every macro variable smiling politely in the same direction before they are willing to buy a good business. That is not how markets work. And it is certainly not how wealth is built. Right now, the market is locked in a push and pull that has been exhausting people. One scenario says tensions cool, the heat comes out of the system, and risk assets bounce hard because the panic was overdone. The other scenario says the conflict broadens, the pressure becomes more chronic, and everything tied to risk and long-duration expectations gets marked down again. That is the tug of war. And because the conflict around Iran has become such a visible headline force, many people feel as though their entire portfolio now depends on the next move from Washington, the next military response, the next ceasefire rumor, the next denial, the next escalation, the next walk back, the next speech, the next leak. I understand why that feeling is so uncomfortable. It makes investors feel small. It makes them feel as though they are no longer owners of businesses, but gamblers sitting in a casino where a few men with microphones can swing their net worth by 10, 20, 30, sometimes even 40% depending on the mood of the week. And when people feel that way, they usually do one of two foolish things. They either panic and sell quality because they cannot stand the uncertainty, or they freeze and stop buying anything at all because they tell themselves they will wait until the world starts making sense again. That second mistake is often more expensive than the first because the world almost never fully makes sense again in the way people imagine. There is always some new reason to wait. A war, a court ruling, a tariff, a rate move, an election, a tweet, an inflation print, a jobs number, a banking wobble, a geopolitical flare-up. The emotional investor always finds a reason to postpone action. The disciplined investor does something else. He opens the chart. He forces himself to look at the long picture instead of living inside the emotional prison of the last 3 weeks. That is the mother line of this whole story. If you are buying actual quality assets for the long term, the short term and the long term are not the same thing. They do not obey the same clock. They do not answer to the same emotions. They do not reward the same behavior. And once you understand that, downturns stop looking like proof that you were stupid for buying. They start looking like the market's way of offering you better prices on things you already wanted to own. That is the right frame. The source material put this beautifully with that simple chart logic. If you zoom into only the ugly patch, the stock looks broken. If you zoom out, the ugly patch often turns out to be a small bend inside a much larger arc of value creation. That is not always true. Some stocks really do break. Some businesses really do decay. Some stories really do end. But if you are dealing with quality, with a durable moat, with management that knows what it is doing, with a business that is still executing, then the market's temporary dislike of the stock is not automatically a verdict on the future. Often it is just a discount wrapped in bad headlines. That is the lens I want to use for every one of the names in this piece, not what is the market angry about this week, but has the business actually broken, or has the stock simply been marked down by fear, rotation, or temporary confusion? That is the real question, and the first name on the list where that question matters is Robinhood. Now, a lot of people still think about Robinhood through its old stereotype, meme stocks, gamified trading, young retail investors pushing buttons too quickly, a platform for speculation more than for serious wealth building. That image still lives in a lot of minds because first impressions are stubborn, and the financial world is full of people who like to keep their narratives long after the underlying facts started changing. But the stock market does not care what story you got comfortable with in 2021. It cares what the business is now, and the argument here is simple. The stock got cut in half. The business did not. That is a very important difference. According to the source material, Robinhood was cut roughly in half from its October highs. The price to sales multiple collapsed from around 31 times sales to around 14 times sales. That is a vicious repricing. But the repricing was not matched by an equivalent deterioration in the business itself. This matters because one of the clearest setups in investing is when sentiment breaks harder than fundamentals do. That is where value begins to form. And if the business is not merely surviving but actually maturing under the surface while the stock is getting punished, then what you may have is not a broken company. You may have a stronger company being offered at a weaker multiple. That is exactly the sort of asymmetry that interests me. Now let us look at the business itself instead of the stock chart. Robinhood has built something much broader than many people realize. This is no longer only a brokerage app for impulsive retail traders. The platform now spans brokerage, options, crypto, futures, margin lending, retirement accounts, credit card products, prediction markets, and even a venture-related apparatus. That is a very broad financial ecosystem. Breadth matters because each additional line can deepen the customer relationship. A shallow customer can be fickle. A deep customer is harder to lose. The source material makes this point directly. Robinhood is not just adding accounts. It is deepening the relationship with the accounts it already has. That is one of the strongest signals a platform business can give you. More revenue per user, more touch points, more reasons for the user to stay, more cross-sell, more habit, more integration into the user's financial life. That is how a platform starts moving from novelty into infrastructure, and infrastructure businesses deserve to be thought about differently than speculative front-end stories. Then there is the Gold subscriber tier. I do not mean the metal, I mean Robinhood Gold. This is a strong recurring revenue layer sitting inside the business. And recurring revenue has a quality that transactional revenue does not. It is steadier, it is more predictable. It tells you the customer is not merely passing through. It suggests the customer sees continuing utility in the product. That matters. Because time excitement is not the same as enduring economic value. The market often confuses those two things. I try not to. Now, the most interesting new development in the source is the federal Trump Accounts program. Government-created savings accounts for American children seated at birth with Robinhood and Banai Mellon positioned as platform partners. Step back and think about what that means. If it happens at real scale, this is not just another product launch. This is pipeline. This is early imprinting. This is millions of future investors touching the Robinhood brand as part of their first formal savings experience. The source calls it a government-backed mandate that plants the brand seed in front of an entire generation before they make their first voluntary investment decision. That is a powerful description, and it is correct. Distribution is one of the hardest things in business to build. If the government itself helps open a distribution path into the next generation of customers, you should take that very seriously. It does not guarantee monopoly. It does not guarantee permanent dominance. But it absolutely strengthens the long-run customer acquisition machine. And that is what I care about. Then there is buybacks. This is not a trivial point management. Authorized a large share repurchase program. They are not acting as if the falling price invalidates the long-term business. They are acting as though the stock is attractive enough to buy themselves. That does not prove they are right. Management can be wrong, but I always pay attention when insiders respond to weakness with repurchase rather than panic. That is a sign of confidence from inside the walls. Now let me tie the Robinhood case together the way I think it deserves to be understood. The stock was cut in half, the multiple compressed brutally, but underneath that compression sits a business that is not shrinking into irrelevance. It is broadening, deepening, and embedding itself more firmly into user behavior. That is what makes the setup interesting. The market is treating it with one kind of mood. The business is progressing with another kind of reality. Whenever I see that split, I want to study harder, not walk away faster. Now let us move to the third stock in the source countdown, Nike. This one is emotionally different because Nike is not a story. People are just discovering. Nike is an institution. It is one of the most recognized brands on the planet. That is part of what makes the setup so fascinating. The stock peaked in late 2021 and now sits around levels not seen since the middle of the last decade. In other words, about 12 years of stock market progress got wiped out. That is not a small move. That is a public humiliation. And humiliation creates opportunity only if the underlying thing still deserves respect. So the question is obvious, does it? The source is honest here in a way I appreciate. Nike did not merely get dragged down by macro weakness. This is not one of those lazy stories where everything was wonderful and the market just got irrational. There were real mistakes. The prior CEO made serious strategic errors. And if you are going to buy a turnaround, you should be clear about what actually went wrong. The first mistake was pulling too aggressively away from wholesale partners and trying to force the ecosystem through Nike-owned direct digital channels. That likely looked clean in a boardroom presentation. Better margins on paper, more control, more direct customer ownership, less dependency on retailers. Those things always sound elegant in theory, but the retail world is not theory. Physical presence matters, habit matters, discovery matters. Being where ordinary people actually shop matters when you weaken your presence in the real world channels where regular people encounter your product. You create space for rivals. And once space opens in consumer markets, competitors step in. That is exactly what happened. The second mistake was product complacency. Instead of keeping performance innovation at the center, Nike leaned too hard into the same classic franchises again and again. Dunks, Air Force Ones, Jordans, those are iconic lines. But icons can be overexploited. The market eventually saturates. Something rare becomes common. Something coveted becomes easy. The social heat drops. That is what overdistribution does. The third mistake was even more damaging because it left an opening exactly where competitors wanted one. While Nike leaned on old silhouettes and weakened the wholesale network, other brands moved aggressively into the performance gap on running. Hoka, New Balance. These names found younger attention, fresher energy, and a more current relationship with performance consumers. That matters because brands rarely die in one moment. They weaken by giving away relevance piece by piece. So, yes, the prior CEO did damage. This should not be romanticized. But now we get to the turn. The new CEO, Elliott Hill, has decades of Nike experience and came back specifically to fix the mess. That matters because turnarounds are not only about what broke, they are about whether the right operator is now sitting in the chair. The source frames this as a multi-front repair job, rebuild wholesale relationships, restore product and innovation emphasis, repair the overdistribution damage, win back younger and more performance-driven audiences. That will take time. Turnarounds almost always do. Markets know that, which is why the stock is discounted so severely. But discount is the key word. A turnaround becomes interesting when the market has already punished the stock hard enough that the brand, the distribution engine, and the long recovery potential begin looking cheap relative to the current quote. That is the case being made here. Not that Nike has already fixed everything, that the discount is so severe that you are no longer paying for perfection. You are paying a price that assumes a great deal of pain and skepticism is already in the stock. That is where value begins. And I understand that argument because if the brand alone is worth more than what the market now implies, and if even a partial repair is possible under a more competent operator, then the upside from today's compressed expectations can be meaningful. This is what many people forget in turnarounds. You do not need full glory restored immediately. You only need reality to be better than the misery already priced in. That is enough to make money. Now let us move to Salesforce. This one is different again, because here the problem is not consumer, brand failure. It is software fear. The market right now is treating large parts of software like a graveyard of future disruption candidates. People are trying to guess which businesses artificial intelligence will hollow out, which will be replaced, which will be commoditized, and which will become less valuable. Because the old mode of software interaction is changing, that fear is real, and because the fear is real, good assets can be sold down too far along with weaker ones. That is where Salesforce enters. The stock peaked around the mid-$300s and is now sitting around half that. The price-to-earnings multiple, according to the source, collapsed to about 22.58 times earnings. roughly half of what you were paying a year earlier and far below many historical points, that alone gets my attention. But again, a falling multiple is not enough. I want the moat. And this is where Salesforce remains deeply compelling. Once a large company builds its sales operation, customer support workflow, internal records, and marketing infrastructure around Salesforce, moving off that system is not some clean weekend project. It is disruption. It is retraining. It is data migration risk. It is operational interruption. It is political pain inside the enterprise. It is expensive. Those are switching costs. And switching costs are among the most valuable moats any software company can have. A platform that is annoying to leave has more pricing power, more staying power, and more strategic leverage than a product customers can swap out casually on a Tuesday. That is why I take lock. And seriously, the market often underestimates how much enterprise customers will tolerate in order to avoid ripping out foundational workflow systems. Now, add Agentforce. This is where the future leg of the story begins. The source presents Agentforce as one of the biggest launches in Salesforce's history, possibly the biggest in more than a decade. And the logic is clear. Instead of human beings manually updating records, handling routine support tasks, routing tickets, producing reports, and doing the repetitive work inside the Salesforce environment, AI agents begin doing that inside the customer's own data and workflow layer. That is not a gimmick. That is the actual shape of enterprise AI monetization. Not some abstract promise, a workflow change, a labor reallocation, a productivity tool that sits in the actual operating system of the customer. That is powerful. And the source does not leave it at concept level. It points to real deployment. Tens of thousands of Agentforce deals, quarter-over-quarter growth in paid transactions, used by the U.S. Department of Labor, used inside the Veterans Health Administration, used by large private players as well. That is the kind of evidence I want. Not AI could matter. But AI is already being deployed in a way that strengthens the moat of the existing platform. That is very different. The bear case wants you to think Salesforce is one of the things AI destroys. The bull case here is that Salesforce is one of the platforms AI helps become more indispensable. That distinction matters. And again, you do not need to believe the most euphoric version of the future for this to be a good setup. You only need to believe that the lock-in remains real, that the customer dependence remains real, and that Agentforce or adjacent capabilities improve Salesforce as relevance rather than reduce it. If that is true, then the current compression begins to look like a broad software fear trade rather than a correct verdict on the business. That is the setup. Now we come to the final name, Applied Digital. This one is closer to the infrastructure layer of the AI build-out, and the source treats it as the number one name on the list for a reason. The stock is down around 40% from late 2025 highs. That alone might not mean much. Plenty of names are down 40%. What matters is what happened underneath the price decline. And according to the source, the recent earnings report was explosive. The market expected around $76 million in revenue. The company printed $126.6 million. That is not a modest beat. That is a violent beat. Roughly 66% above expectations, with year-over-year revenue growth around 139%. Those are not the numbers of a business limping through an overhyped sector. Those are the numbers of a business in real acceleration. And not only did the company produce strong revenue, it also delivered positive adjusted EBITDA and adjusted net income. That matters because speculative infrastructure stories often live too long on hope and too little on actual economics. This one, at least by the source's framing, is moving toward real financial substance. Now step back and ask what this company actually is. Applied Digital is not just another generic data center operator. The argument is that it builds and operates facilities specifically engineered for the extreme density, cooling, and power requirements of AI and high-performance compute. That is a different type of infrastructure. The world does not merely need more generic server space. It needs facilities capable of handling extreme AI workloads around the clock. That is a more demanding business. It is also potentially a more valuable one if demand stays hot. Then there is the CoreWeave relationship. This is a serious anchor. CoreWeave is a major AI cloud player. NVIDIA, backed, fast-growing, strategically important. And CoreWeave chose Applied Digital to build and operate key compute infrastructure. That is not a small validation, and the North Dakota campus tied to this relationship runs into the billions over a multi-year time frame, according to the source. That is exactly the kind of contract. Back pipeline you want to see in a company building hard assets at scale. Now add Delta Forge 1 in Louisiana, a large new campus under development. The point becomes obvious. This is not a company standing still with one lucky contract. This is a company expanding the platform while the AI compute build-out is still happening. The source also highlights a financing point that matters enormously. Instead of constantly flooding the market with new shares, Applied Digital is funding itself more by borrowing against the physical data center assets and the contracted future payments tied to them, almost like infrastructure financing around airports or toll roads. That is a much more mature and sustainable structure than endless dilution. It means management is thinking in asset, financing terms rather than in promotional stock terms. That matters. Because investors in infrastructure, heavy growth stories need to know whether the company will feed growth by constantly taxing shareholders or whether it can build with smarter capital structure. That is one of the big questions. The source argues the answer here is encouraging, and if that is true, then you have a very interesting combination, a stock down materially from highs. An earnings report that dramatically beat expectations, a contract-backed AI infrastructure story, expansion into new campuses, and financing discipline that is at least moving in a more serious direction. That is the kind of setup I understand. Now let me pull the whole piece together the right way. Robinhood is about a business platform maturing faster than the market is willing to credit, while the stock remains heavily marked down. Nike is about a damaged but still massive brand where a severe discount may now be more than pricing in the management mistakes already known. Salesforce is about software fear creating compression in a business with enormous switching costs and a plausible path to becoming even more embedded through AI agents. Applied Digital is about AI infrastructure, real revenue acceleration, major counterparties, and a stock that may still be punished more for market mood than for business weakness. Four very different stories. One common logic: the market is emotional. Your job is to be selective, not emotional. Now let me tell you the identity shift that matters most in all of this. Most people think in headlines. I want you to think in long charts. A headline mindset says, what just happened? A long chart mindset says, where is this business in its larger arc? A headline mindset treats volatility as information. A long chart mindset treats volatility as a test. A headline mindset asks whether the market is comfortable. A long chart mindset asks whether the business is still compounding value underneath temporary discomfort. That is the difference. And if you can make that shift, 2026 gets much easier to survive intelligently, because then you stop pretending you need a crystal ball. You stop acting as if short-term macro noise automatically invalidates long-term business value. You stop chasing emotional certainty. You start asking the right question instead. Is this a quality asset that is temporarily down, or is it actually breaking? That is the whole blueprint. Open the chart, respect the long term context, separate macro pressure from business deterioration, demand a real moat, demand evidence. And then, if the stock is down but the business still deserves conviction, act like an owner instead of a spectator. That is the final choice. You can keep living inside the push and pull of every geopolitical headline and let your portfolio be ruled by whichever scenario the market is pricing this hour. Or you can do the harder, more profitable thing. You can buy strong businesses when the market is too scared, too impatient, or too distracted to price them properly. I know which side of that choice I prefer. You should too.